Ever wondered why your investments seem to sink no matter what you do? Imagine watching a stock tumble from $12 to $9. What's your next move? Do you double down, walk away, or just hope for the best? The truth is, owning the wrong investments can trap you in a cycle of losses. Today, we're diving deep into the key reasons why certain investments are doomed to fail and how you can avoid these pitfalls. Let's break down the essential truths every investor needs to know to succeed. Know what you own. It's astonishing how many people own stocks they can't explain to an 11-year-old in 2 minutes. They buy these stocks simply because they believe the stock's going up. This lack of understanding is a recipe for disaster. To make money in the stock market, you need to know what you own and why you own it. Imagine investing in a company with a product as complex as a 1 megabit SRAM CMOS bipolar risk floating point data I/O array processor. Sounds impressive, right? But if you can't explain it, you'll likely never make money from it. Investing isn't about picking the most sophisticated sounding stocks. It's about understanding the businesses you're investing in. I prefer investing in companies like Dunkin' Donuts, Stop and Shop, and CVS. These are businesses with simple stories and products that people use every day. If you can't explain the company's product or service in simple terms, you're likely making uninformed decisions. Knowing what you own means understanding the company's business model, market position, and growth potential. It's the foundation of informed investing, and without it, you're just gambling. Predicting the economy is futile. One of the biggest traps investors fall into is trying to predict the economy, interest rates, or the stock market. The idea of timing the market is appealing, but it's nearly impossible to do successfully. In the early 1980s, we saw a prime rate of 20%, double-digit unemployment, and inflation. No one predicted that, yet many tried. Economists and analysts often get it wrong, making predictions that never come to fruition. If you spend 13 minutes a year on economic forecasts, you've wasted 10 minutes. Focus on what you can control. The market goes up and down, sometimes dramatically. The stock market is unpredictable, and trying to foresee its movements is a waste of time. Rather than relying on unreliable predictions, investors should focus on the basics. By accepting the inherent volatility of the stock market and understanding that it will experience ups and downs, you can better manage your investments. Focus on your long-term goals and don't be swayed by short-term fluctuations. This approach will lead to more stable and successful investing, freeing you from the anxiety of predicting the unpredictable. Deal with facts, not predictions. Investing is more about dealing with the reality of facts than it is about relying on predictions. Predicting the future, whether it involves the economy, stock market trends, or interest rates, often proves futile. While it might be tempting to base investment decisions on forecasts or speculative insights, the truth is that they can be dangerously unreliable. Instead, it's far more effective to focus on tangible facts and data available to you. If you notice a company's inventory rising or a dip in market demand for its products, these are concrete signals that should guide your decisions. Similarly, monitoring economic indicators such as freight car loadings or copper prices can provide valuable insights into current economic conditions. Trust these facts rather than predictions, which are often based on assumptions that might not hold true. By focusing on present realities and factual evidence, you minimize risk and make smarter investment choices. Remember, factual analysis always trumps speculation. Base your strategies on data you can verify, not on uncertain forecasts. Be patient. Patience is one of the most crucial virtues in investing. You don't need to rush into buying stocks or make impulsive decisions. Take Walmart, for example. An investor could have bought Walmart 10 years after it went public and still made 30 times their money. There's always time to get into a good investment, and rushing can lead to mistakes that could have been avoided with a bit more patience. Waiting for the right moment to invest can yield significant returns, proving that patience truly is a virtue in this business. The idea of making a quick profit is tempting, but successful investing often requires a long-term perspective. Patience allows you to ride out market fluctuations and make more informed decisions. By waiting for the right opportunity, you can invest with confidence, knowing that you've done your homework and are making the best choice for your portfolio. Investing isn't about getting rich overnight. It's about building wealth over time through careful, considered decisions. This long-term approach is key to achieving success in the stock market, and patience is your greatest ally in this journey. Don't assume stocks can't go lower. A common mistake investors make is believing that a stock can't drop any further simply because it has already fallen significantly. This assumption can lead to substantial financial losses. Take Polaroid, for example. The stock price plummeted from 140 to 107, and many investors thought it was a bargain, convinced it couldn't fall below 100. They bought at 110, only to watch it eventually crash to 18. This experience serves as a stark reminder. Just because a stock has dropped significantly doesn't mean it has hit its lowest point. Before buying a falling stock, it's crucial to understand why it has decreased and whether the company still has a strong foundation for future growth. This requires a thorough analysis of the company's fundamentals, market position, and potential risks. Without this understanding, you risk making poorly informed decisions that can lead to more losses. Always remember, a stock that has fallen can still fall further. Don't be lured into buying just because it appears cheap. Focus instead on the underlying reasons for the drop and the company's true value. Don't assume stocks can't go higher. Just as you shouldn't assume stocks can't go lower, it's also a mistake to think they can't go higher. Investors often sell stocks that have risen significantly, fearing that the stock price has peaked. This assumption can lead to missed opportunities for substantial gains. Take Philip Morris as an example. In 1951, it sold for just 12 cents. By 1961, the price had increased fivefold, and many investors thought it couldn't rise any further. However, it continued to climb, eventually becoming a 100-bagger. The same story unfolded with companies like Home Depot and Toys R Us, where investors sold their shares prematurely, only to watch the stock price soar. When a stock has risen, it can be tempting to take your profits and move on, but doing so may prevent you from capitalizing on further growth. Evaluate the company's market position, potential, and future prospects before making decisions based on short-term gains. By holding on to your winners and maximizing your returns, you can ensure that you're not leaving money on the table by selling too soon. Investing successfully isn't about chasing hot tips or trying to predict market movements. It's about understanding your investments, focusing on facts rather than forecasts, and avoiding common pitfalls. By knowing what you own, being patient, and staying informed, you can make smarter decisions that lead to long-term financial growth and stability. Thank you for watching. If you found this video helpful, please like, share, and subscribe for latest content. Until next time, keep learning and growing your investment knowledge by watching this video next. See you in the next one.